And today we're going to be looking at the growth market ETFs. So these are the passively managed ETFs, and we're also going to be diversifying ourselves into the international outside of Canada market. Hello everyone, my name is Alex, welcome to my channel. I hope you're doing well, I hope you're staying safe, and I hope you're ready for some growth today. Yeah. So most of the time I cover dividend stocks, dividend ETFs, and how to build your dividend portfolio. And I'll keep doing it going forward because this is my primary investment strategy. However, today we're going to be covering growth ETFs and what are the best picks you can do on a Canadian stock market. Let's get started. Let's take a look at some stats first and see what we're dealing with. ETFs, exchange traded funds, are one of the most important and valuable products created for individual investors in recent years. They offer diversified exposure to multiple positions and lower overall volatility of your portfolio. In 1993, the first one was created with the ticker symbol SPY, or Spiders, which became eventually the highest volume ETF in history. And today, in 2021, ETFs are estimated at $5.8 trillion, with around 2,500 ETFs on the US stock market. And TSX provide access to around 800 different ETFs across around 40 different providers. There are also different types of ETFs. There's a market ETF, there's a bond ETFs, there's sector and industry ETFs, commodity ETFs, style ETFs, foreign market ETFs, inverse ETFs, actively managed ETFs, exchange traded notes, and alternative investment ETFs. All of those have different meaning and then provide different value. But today we're going to be taking a look at the market ETFs, which are the passively managed ETFs that are tracking specific index. For example, S&P 500 or NASDAQ. So why do you actually care about the ETFs, right? So there are a couple of advantages that ETFs have. They're easy to trade. You can trade them as individual stocks. So you know how to do that, right? They're also very transparent. So you know what the index they're tracking. So you know what's happening, what the portfolio looks like, what the holdings are and whatnot. You can do different trading transactions. You can put like limit orders for buy and sell, the same as you do for stocks. And you also diversify your portfolio with the multiple companies at the same time when you buy in a single ETF. There are also ETFs that track the entire stock market. For example, there's a VTI ETF that covers the entire US stock market. Or there's a VXUS ETF that covers all the international stocks except US. So you are diversifying your portfolio not only with US stock market, but also with stocks outside of US. The same thing goes with Canada. There are certain ETFs that tracks either US stock market, Canadian stock market, or some international stock market. There are also some disadvantages to ETFs. And the main one, the most important one, is their MER, the management expense ratio, which is basically a fee that you need to pay for holding their ETFs. Those fees are deducted automatically. You don't need to pay them monthly or whatever. They're deducted from the growth you're getting. And today we're going to be looking at the growth market ETFs, where each track a specific index. So these are the passively managed ETFs, and we're also going to be diversifying ourselves into the international outside of Canada market. And why growth ETFs are actually important. First, it gives you exposure to the stocks that are not paying dividends, but potentially can give you more in market appreciation. Some of the growth ETFs are into innovation and future-looking industries. And most of the time, those companies are not paying dividends yet because they still need a lot of money to reinvest back to themselves in order to grow, to innovate their businesses. And if you're interested in those, that's probably the best way to look at it. And the other point is that if you don't have enough room left on your tax shelter accounts, your TFSA, RSP, RESP, and you're also in a higher tax bracket, so you might consider moving from dividend stocks to growth stocks to save some money on taxes. And ETFs would be a very good way to diversify your portfolio. If you want to know more about taxes, how all that works, and why you're going to be paying less taxes if you're into growth stocks, let me know in comments below and I'll definitely make a video for that. And if you haven't filed your taxes yet, don't worry, I'll get you covered. Check out the link above where I go with a simple tax tutorial on how you can file your taxes on your own for free. So back to our ETFs. So you can build a very well thought out portfolio with dividend ETFs, dividend stocks, growth ETFs, and benefit from a long-term growth. Canadian stock market is definitely smaller than US stock market, but don't worry about that because there are ETFs on a Canadian stock exchange that tracks indices on the US stock market. So we can totally invest into those as well. And I'll be focusing on a couple of critical metrics today. First, the MAR, so the management expense ratio, shouldn't be greater than 0.5%. And the second one is long-term growth. So I'm expecting from our ETFs to give me returns approximately 10 to 20% annually. Yeah, we're not going to be looking at meme stocks today, unfortunately, where your share price jumps 1000% up and down every single day, because we're still investing for a long term and want to take a look at the long-term growth as well. And the first we're going to be looking at today is the BMO S&P 500 Index ETF. The ticker symbol is ZSP.TO. ZSP has been designed to replicate, to the extent possible, the performance of the S&P 500 index. The ETF invests in and holds the constituent securities of the index in the same proportion as they're reflected in the index. The fund looks to mirror the S&P 500 index, and it contains a broad mix of different sectors, including tech, healthcare, financial services, communications, and many others. It is an easy way to diversify and mimic the returns of the S&P 500 in US. The top 5 companies that this index holds are from the tech sector. Companies like Apple, Microsoft, Amazon, Facebook, Google, Tesla. And tech also is the biggest sector in ZSP. It accounts for around 26%. The other big players there are healthcare, 13%. There's consumer discretionary for 12%, financials 11%, communications 10%, industrial 8%. And as you can see, you're diversifying your investments pretty good investing into this ETF. Let's take a look at our metrics now. So net assets for the ZSP is around $8.7 billion. What it means is that the total number of shares that this company holds accounts for around $8.7 billion. That's pretty big, right? There's an American alternative for this ETF as well, which accounts for $248 billion. The MAR is pretty low with at 0.09%, so we're not going to be paying a lot of fees, which is good. The share price as of today is around $56, so it's pretty easy to enter into this ETF. And since the inception of this ETF in 2012, the share price grew by 266%. So we're looking at around 20-25% return annually. The beta parameter is at 0.98, so it's pretty safe investment in terms of share price volatility. And it is a great ETF because, for example, if you want to invest individually into companies like Apple, Amazon, Microsoft, Tesla, Google, you need to require a lot of money to start doing that. Because, for example, if you want to buy an Amazon stock, you would be required to pay $3,000 just to own a single share of Amazon. Where buying this ETF, you'll be diversifying and owning all these different shares at once. There are also 2 very similar ETFs that also tracks S&P 500, the VFV, the Vanguard S&P 500 ETF, and XSP, which is iShares S&P 500 ETF. They have some very tiny difference between themselves, but pretty much the same. The Vanguard S&P 500 ETF VFV, it is the same as the VOO, which is also a Vanguard S&P 500 ETFs, but on the US stock market. So they are identical, just one is in Canada, the other one in the US. So that's the benefit of going into ETFs if you want to be exposed into companies outside of Canadian Stock Exchange. So all these 3 ETFs holds S&P 500 large cap companies, and they've been performing very similarly over the last 10 years. Alright, let's move on to the next one, which is the Horizons Nasdaq 100 ETF. The ticker symbol is HXQ.TO. This ETF seeks to replicate, to the extent possible, the performance of the Nasdaq 100 index. The index includes 100 of the largest US and international non-financial companies listed on the Nasdaq stock market. I would consider this ETF to be a must-have holding on any investment portfolio, and especially on the growth investment portfolio, because you cannot go wrong with the passively managed Nasdaq 100 index, because the index is constantly rebalanced and holds 100 top companies. This will expose you to a broad variety of large and great companies on the Nasdaq stock exchange. There's a US ETF QQQ that holds these same companies, the same weight of the companies as HXQ, but it's been around for a longer time, so we have more data to look at. For example, for the last 20 years, QQQ returns were 20% annually. This is crazy. You're basically getting 20% returns on your investment every single year. Where else you can get that? And if you account for the diversification that ETF provides, how else you can do better? This is an incredible stability in performance. When you look at the holdings per sector on this ETF, information technology is definitely on top of the list. It accounts for around 47%, which is a lot. Communication and consumer discretionary accounts for 20% each as well. As you can see, there is no financial in there, so you are diversified in all other sectors but financial, which is pretty good because Canada is a lot into finances. And we have a lot of good stocks in financial sectors that you can add to your portfolio. Actually, I was talking about those here, so check this out. Now let's take a look at our metrics for this ETF. The net assets accounts for around $274 million, so it's definitely not the largest ETF we have, but it's actually pretty good in terms of returns they provide. The MER is around 0.28%, so it's a pretty low MER considering what the returns we're getting in return. There are no dividends here, so the dividend yield is 0. If you are interested about the dividend ETFs, go check the link above where I go about the best Canadian dividend ETFs that you can add to your portfolio. Back to our ETF. The share price as of today is around $97, so it's a pretty easy entrance if you want to invest into it, and it also gives you a very good exposure into different stocks that are placed on the Nasdaq Stock Exchange. This ETF was added to TSX around 5 years ago, so over the last 5 years, the share price grew by 224%. So we have around 20-25% returns annually from this ETF. And its American sibling QQQ can also prove that as well. The beta parameter is at 1.04, so it's a pretty good stock in terms of share price volatility as well. Now let's move back to a Canadian stock market. So the next one is the iShares S&P TSX Capped Information Technology Index. The ticker symbol is XIT.TO. So this ETF targets exposure to Canadian information technology companies, which basically means that this ETF invests into the top Canadian companies that operate in tech industry, such as Shopify or BlackBerry and others. This fund was created in 2001, and as you can see, it was pretty much flat in the first 10-15 years of its life. But then, with more innovation and more tech companies being created in Canada, the growth was inevitable. As of today, this ETF holds around 19 companies, and that number changes pretty frequently as more companies are created and added to TSX. For example, around 6 months ago, they only had 16 holdings there. But it also showcases how small the tech industry in Canada. Come on, Canadians, we need to create more tech companies. We need to catch up with our friends from US, as they're been on fire for the last 10 to 20 years for sure. The top 5 holdings of this ETF makes up of 80% of its entire portfolio, which again showcases how small the Canadian tech is and how dominant it is by the biggest players. Now, if you look at the top 2 holdings of XIT, Shopify and Constellation Software, their stock trading at around $1,000 or even more than that. So it's pretty hard to invest in the companies like this. And then this ETF comes to help here, where you can invest into it and be exposed to companies like this. As of making of this video, the share price is around $48, which is great, and this is a fantastic return for an ETF. Now let's take a look at our metrics for XIT. So the net assets, they have around $450 million. The MER is pretty high, is at 0.61, but also the returns you're getting is going to blow your mind as well. There are no dividends here, so the dividend yield is 0. The share price as of today is at $48, and it grew in the last 10 years by 620%, which is insane. It's around 20-25% growth annually. Crazy. The beta parameter is at 1.38, so there is some share price volatility, but nothing crazy. And if you are interested in investing in Canadian tech, XIT is one of the best ETFs you have to do it. And I certainly have in my portfolio as well, because I cannot miss out on Canadian tech growth. And that's it for today. Thank you for watching. Don't forget to smash that like button. Let's reach out to more people so more people get started with investing. Also subscribe, hit the bell, and I'll see you around. Cheers, bye.